Hi, I'm Sunil Maheshwari. I'm a professor of accounting at Eberly College of Business at Indiana University of Pennsylvania. Today, we will be talking about the cost volume profit analysis. We have already covered the basic concepts of cost volume profit analysis earlier, but we will go over the definitions once again. In addition, up till now, we have learned about break-even point for a single product. In this chapter, we will go to the multiple products. So if there are more than one product in the sales mix, how do we compute the break-even point? Also, we will see the impact of sales mix when a company has limited resources and the impact of operating leverage and the cost structure of how it impacts the profitability. Cost volume profit analysis or CVP analysis, or sometimes also called break-even point analysis, studies the effect of changes in cost and volume on a company's profit. So what happens if the variable cost, say, goes down by 20%, or what happens if the volume of sales increases by 5%. All these aspects are important to the planning process because it will help to determine what kind of product mix a company should have to optimize the profits, or how can we use our production facilities in the best way or set in reasonable selling price. In the CVP analysis, what we are going to do is we are going to use a special income statement format which basically distinguishes between fixed and variable cost. It will report the contribution margin, and I'll show you an example of that. In general, the CVP or the variable format income statement will show your sales less variable cost. Sales less variable cost will give you the contribution margin. In the second column, you see the contribution margin per unit. So you've got the selling price of 500 less variable cost of 300, giving you $200 of contribution margin. Out of the total contribution margin, you can take out the fixed cost to get net income. So please do remember this format where it says sales less variable cost gives you the contribution margin, less fixed cost gives you the net income. If we wanted to expand the same income format, that is a CVP income statement or variable costing income statement, you can have the manufacturing, selling, and administrative variable expenses put together under variable expenses. Similarly, manufacturing, selling, and administrative expenses, fixed expenses, under the fixed expenses to give you the net income. To compute a break-even point, that is a point where there is no profit or no loss, you studied earlier that fixed cost divided by contribution margin per unit can give you a break-even point. So if the fixed costs are $200,000, your contribution margin is $200. Your break-even point in number of units, that is a point of no gain, no loss, is 1,000 units. In case you want to achieve a certain amount of net income, because businesses are there not to make zero profit, but to earn a certain amount of income. In that case, our formula gets modified a little bit, and to the fixed cost, you add a target net income, which in break-even point is zero. But if you have got a target income of $120,000, you add that to the fixed cost, divide by the contribution margin of $200 per unit in this case, and you get a required sales in unit for 1,600. So what it tells you is that you need to sell 1,600 units to make a profit of $120,000, which is targeted. Another important concept which relates to the break-even point is margin of safety. That basically means how much over the break-even point the sales are expected to be there. So if you take out the break-even sales from the actual expected sales, you get the margin of safety in dollars. This can also be expressed as a ratio. So in this case, if you assume $750,000 to be sales, break-even sales expected at $500,000, then your margin of safety is $250,000. That basically means that this is the safety net you have, and your sales can fall by about $250,000 before you start to incur any losses. Once we have done the break-even point for single product, we will move on to multiple products now. In a company might always sell more than one product. So let's take an example. If a company sells a mix of printers and computers, where printers are consist of 80% of the total sales volume, and computers consist of 20% of the total sales volume, then the sales mix is considered as 80% to 20%, or 80 is to 20. Because different products have different contribution margin, the sales mix is an important consideration. It is used as weights to compute the weighted contribution margin to get the break-even point in terms of multiple products. When we talk about a sales mix, what we are talking about is the relative proportion of units sold for each of the product in total sales. So for Vargo Video, for example, it has 2,000 units of total sales. 1,500 are camcorders and 500 are TVs. The total units sold are 2,000. So the sales mix ratio is 75% to 25%. Why is this important? Because we use these as the weights to compute the weighted average contribution margin for the sales mix, which will be used for computing the break-even point. So as we said, the sales mix is 75 is to 25 for the camcorders is to TVs in the total sales mix. And the unit contribution margin is $200 for camcorders, and for the TVs it's $500. Fixed cost is total of $275,000. We will modify our break-even point formula a little bit, which was fixed cost divided by the unit contribution margin. And to compute the weighted contribution margin, for camcorders, for example, you have got the unit contribution margin of $200, 75% is the sales mix percentage, and for the TVs, it's 500 multiplied by 25%, which is the sales mix percentage weighted. So total weighted average unit contribution margin is $275. To compute the break-even point in this case, you take the fixed cost of $275,000 and divide by 275, which is the weighted average unit contribution margin of $275. In this case, you get the total break-even points of 1,000 units. These 1,000 units will be produced in the ratio of 75 is to 25%. So if you take 75% and 25% of 1,000, you've got 750 units of camcorders and 250 units of the TVs. And the total contribution margin for that will be total of $275,000. If you are to compute the break-even sales in dollars, our formula for a single product break-even is fixed cost divided by the contribution margin ratio. In this case, since there are more than one product, we will compute a weighted contribution margin ratio. Now, when we compute the break-even sales in dollars for multiple products, we will modify the existing formula for a single product, that is fixed cost divided by contribution margin ratio, to fixed cost divided by weighted contribution margin ratio. And I'll show you how to compute a weighted contribution margin ratio to get the break-even dollar in sales. So if you've got, in this case, you've got two divisions, plant, outdoor plant and indoor plant division. Your contribution margin is $80,000 and $240,000 respectively. And for the plant division, you've got a contribution margin ratio of 20%. For outdoor plant, you've got a contribution margin ratio of 80%, which is basically contribution margin divided by sales. Now, these two ratios, when you combine it together for a total contribution margin of $320,000 divided by $1 million, your contribution margin, weighted contribution margin ratio is 32% with a fixed cost over there for $300,000. So the weighted contribution margin ratio will replace the contribution margin ratio in our original formula. So for the indoor plant division, your contribution margin ratio is 40%. Your sales mix percentage for the indoor plant is 20%. So multiply the two. You add that to the contribution margin ratio of outdoor plant at 30% and sales mix percentage of 80%, giving you a weighted contribution margin of 0.32. You take the $300,000 of fixed cost and divided by the weighted contribution margin ratio of 32%, which gives you a break-even point in dollar sales of $937,500. Now, this $937,500 will be broken down into 20% and 80%, which was the original sales mix. So if we are to break it down, 20% of 937,500 at 187,500 and 750,000 for the outdoor plant. So this is how you can compute the break-even sales in dollars for a given sales mix. Now, most of the companies will have some limitation with the resources, one resource or the another, which will hamper the productivity. So let's take an example. If your contribution margin for camcorder is $200 and TVs is $500, it takes 0.2 of an hour and 0.625 of an hour to make one camcorder and one TV respectively. Then for every hour, you can produce about 5 camcorders at a contribution margin of $200. You'll have a contribution margin per hour of $1,000. However, although TV has a higher contribution margin ratio, but since it uses more of the bottleneck resources, in this case the machine hours, the total contribution margin per hour is $800 only, which is less than every hour if you produce the camcorder. So in this case, this information can be used by the management to make a decision that camcorders should be produced first if the demand exists. Once the demand for the camcorders is filled up, then you produce the TV, because for every hour of scarce resource, in this case the machine hour, we are producing higher contribution margin for the camcorders. So if you produce the camcorder, 600 camcorders, and if you use all 600 machine hours for camcorders, you will have a contribution margin of $600,000, versus if you use that additional 600 hours for TVs, you'll have a contribution margin of $480,000. So in this case, it will be better to produce camcorders first, and that is limiting the resources. Now, we will also now look at the impact of the cost structure on cost volume profit analysis. Company must carefully choose its cost structure, because more higher the fixed cost it is, it becomes more risky. And that is what is referred to as operating leverage. So if you look at these two companies, Vargo Video and New Wave Video, you notice that your variable costs are significantly different, because Vargo Video is using traditional costing method, labor-intensive costing method, whereas New Wave is using the latest technology. However, for the New Wave, your fixed costs are much higher. That is at $520,000. So they will have to sell more units just to even break even. However, the Vargo's fixed costs are $200,000, and at the level of $800,000, they are making the same profit. But due to this difference in the cost structure, whenever a variance or the change in sales takes place, it will have a greater impact on the net income. So how does it affect the contribution margin ratio? If you look at the cost structure, your net income is same for the time being. Your sales is $800,000 and your contribution margin is $320,000 and $640,000. If you look at the contribution margin ratio, Vargo Video has a contribution margin ratio of 40% versus 80% for New Wave, because their variable cost was lower. So it is contributing more per unit for New Wave as opposed to the Vargo video. For every dollar of sales, New Wave, you're getting a contribution margin of 80 cents versus 40 cents. Now, due to that reason that fixed costs are higher, the New Wave's cost structure will be more sensitive to changes in sales. And New Wave will need to generate about $150,000 more in sales than Vargo to just even break even. So if there is a decline in sales that takes place, then New Wave will face much bigger problem than Vargo for the time being. To be specific, if you look at the margin of safety, which we did earlier, which is the excess of sales over the break-even sales. For Vargo videos, 800 minus 500, 300,000 is the margin of safety. If you compare it to the actual sales, the Vargo videos margin of safety is 38%. For New Wave, the margin of safety is 19%. So what it basically tells you is Vargo can sustain a 38% decline in sales before operating at a loss versus 19% decline for the New Wave. So in this case, the Vargo video is less riskier versus the New Wave, which only has 19% margin of safety. So whenever the higher fixed costs are there, and the higher will be the operating leverage, and higher the operating leverage, higher the risk. That basically means that the changes in income will be more significant in companies with higher fixed cost. To compute the degree of operating leverage, you take the contribution margin and divide it by the net income. So for Vargo video, 2.67 is the degree of operating leverage. For New Wave, the degree of operating leverage is 5.33. What does that really mean? That basically means that if the sales changes by 1%, the net income will change by 2.67% for Vargo. If the sales changes by 1%, the net income will change by about 5.33% or 5.33 times for the New Wave. So in a way, if the sales decline, you'll have New Wave to be much riskier than Vargo video. So New Wave's earnings could go up and down as much as 2 times than compared to the Vargo video with an equal increase in sales. Or similarly, if there's a decrease in sales, then it will go down faster, twice as fast as Vargo. So today we went through the sales mix effect on the break-even point. We also went through the impact of operating leverage on the profitability. We also computed the sales mix using when the company has limited resources. And all these have impact upon the break-even point and the decision-making power of the management. Have a nice day, everyone.